Good morning and welcome to the Bulls, Bears, and the Bell Morning Edition. Thank you for joining us. We're diving straight into the source material defining the mood this morning, November 5, 2025. And we're jumping right in because the sources are just screaming one thing today. Fear. Real caution. We're not just seeing, mild profit taking. It feels like a sharp collective shift in psychology. The market's entering this session in what reports are calling a deeply cautious risk-off posture. And, well, for good reason, it seems.
It definitely feels like more than just caution, maybe an inflection point. The core idea, the thing uniting all the sources today, is this rapid technology-led repricing happening. And the main concern really is that these lofty valuations in AI stocks are being seen as detached from fundamentals. So yeah, this deep dive should give you the map you need to navigate what feels like a pretty critical phase.
Okay, let's unpack that. Where did this risk-off mood really kick in? The catalyst, the sentiment definer, seems to be Palantir, PLTR. That feels like where this global unwind really picked up speed.
Exactly right. Palantir fell a full 7% in overnight trading. And that drop is, well, it's absolutely stunning because they actually beat their Q3 earnings estimates. It's the classic sell the news reaction, but with maybe a bit more bite this time.
And that bite comes from the context, doesn't it? I mean, this is a stock that's rallied, 170% to maybe even 400% this year, purely on AI hype.
Precisely. So the market's criteria, they've fundamentally shifted. It's not just about delivering solid results anymore. Now you have to deliver results and somehow justify a 400% rally that already happened. And that's it's a near impossible standard. It tells you that AI enthusiasm has hit a more critical phase. Valuations are being questioned hard. The market's basically moving the goalposts.
Right, into the next stadium, maybe?
Yeah.
And that feeling, that sentiment, it spread immediately through U.S. futures. NASDAQ was the clear laggard. We saw immediate sell-offs in other big AI names, too. NVIDIA down 1.7%, Amazon 1.3%. But the real proof that this is systemic, this unwind has gone totally global.
Yeah, the synchronization is the slightly scary part here. Just look at Asia. Japan's Nikkei 225 plunged 2.5%, and that was led explicitly by a massive 10% crash in SoftBank Group.
SoftBank, yeah. For anyone who doesn't follow Japan closely, that's the big bellwether for AI anxiety because of their vision fund investments, right?
Exactly. They're essentially the world's largest tech venture capital firm. So when SoftBank tanks like that, it suggests smart money is getting nervous about high-risk tech bets everywhere.
And we saw something similar in South Korea.
We did. KOSPI fell 2.9%. Samsung Electronics dropped over 4%. It just confirms this retreat from the crowded AI trade is happening worldwide simultaneously, which, really raises the stakes for the U.S. chip companies reporting later today.
Okay, before we get to that after-hours gauntlet, as you call it, we have to talk about the bond market because it's sending a really different signal, almost a paradox.
Yeah, that's crucial context.
I mean, the Fed's been pretty hawkish. You had Chicago Fed's Goolsbee saying he's nervous about the inflation side, Governor Cook reminding everyone every meeting is live. That sounds like inflation warnings. Should push yields up, shouldn't it?
It absolutely should. But bond yields are actually down. The 10-year Treasury yield dipped slightly to 4.075%. And this is the key insight, I think. The bond market seems to be ignoring the Fed's inflation talk and is instead trading on some serious growth fears. So you see investors moving out of volatile equities, like those AI names, and into safer government bonds. It's that classic flight to safety.
Okay, so the bond market's basically saying we're more worried about a slowdown, maybe even recession, than we are about inflation right now. Which means if today's economic data comes in weak, it won't necessarily be seen as good news for rate cuts. It could just confirm those recession fears, especially with CEOs warning about pullbacks.
It could validate the bear case immediately, yeah. That conflict, the Fed worrying about inflation, the bond market worrying about growth, that's the market's biggest tension point today.
Okay, let's shift gears a bit. Beyond just valuation stress, what seems to be spooking the market now are these underlying structural risks, the stuff you can't just fix by beating an earnings number.
That's right. In a risk-off mood like this, these micro risks, company-specific things, they suddenly get magnified. And the sources highlight a couple of specific non-earnings catalysts that are injecting some real foundational uncertainty into the whole tech space.
Let's start with Getty Images, GEET. Stock fell over 8%. And this wasn't about their business performance, was it?
No, not at all. It was because a UK court ruled against the company.
Hmm.
And this was in the first major copyright lawsuit involving generative AI.
Right. And this is huge because it's not just a Getty problem.
Exactly. It introduces a foundational, maybe previously unpriced risk to the entire generative AI business model. Remember, these AI models, they're built on these vast data sets, often scraped from the web. Now, if courts start ruling that companies have to pay for that data, or worse, they have to retrain their models using only fully licensed data.
And development just slows to a crawl, costs explode, and getting new features out takes forever.
Precisely. It shifts the whole risk profile for the sector. It's not just about valuation anymore. It's about fundamental legality. If the data models themselves are legally questionable, the whole structure gets shaky. That one ruling, you could argue, justifies some of the broader AI sell-off we're seeing.
Okay, and then there's governance risk. You highlighted Tesla, TSLA, down about 2.7%. Again, not about car deliveries.
No, this was a clear message from big institutional money. It was triggered by Norway's sovereign wealth fund, huge player, $1.6 trillion, announcing they'll vote against Elon Musk's pay package. It signals that these major institutions are getting serious about governance again. And when the market is risk-off, stability, and predictable governance, they matter more. If a stock is seen as having weak governance, or maybe too much concentrated power, investors get nervous. They see that known risk and think, okay, now is the time to sell.
We also have a pretty stark quantitative signal flashing, right? Extremely high volume in that semiconductor bear ETF, SOXS.
Yeah, that volume in SOXS is, well, it's kind of a smoking gun. We need to understand what it means. This isn't just simple hedging. It's a 3x bear fund. That means traders are making actively managed, leveraged bets that the semiconductor sector, the heart of the whole AI rally, is going to fall hard. They expect triple the losses. It shows that traders, both institutional and maybe retail too, aren't just taking profits. They are actively, aggressively positioning for a deeper, more immediate correction in chips.
That is definitely an aggressive stance. And speaking of red flags, we should quickly mention Beyond Meat, BYND, fell 16% after delaying its Q3 report. Plus, there are reports of a securities fraud investigation. That's never good.
Absolutely not. In a market this jittery, any kind of operational red flag like that gets punished brutally. No forgiveness today.
Okay, let's pivot now to the macro picture, which is complicated this time by something pretty unusual, this data vacuum.
Right. This context is absolutely critical for everyone listening today. The ongoing U.S. government shutdown means there's a real dearth of official government data. And that situation dramatically increases how much the market reacts to private sector data, simply because, well, that's all there is to trade on right now.
Yeah, the sources confirm the big one, non-farm payrolls, is almost certainly not coming out. So investors are forced to trade on what the reports are calling phantom consensus forecasts in these private surveys. The Fed says it's data dependent, but the data's missing.
Which makes the two private reports today absolutely high stakes. They could really dictate the market's direction. First up is the ADP employment change at 8:15 a.m. Eastern. It's basically the private sector's stand-in jobs number now. And the forecast is incredibly weak, only 25,000 jobs expected.
25,000, wow, that's barely above zero. Bordering on recessionary, if that number actually prints, it just confirms those growth fears the bond market is already signaling, puts enormous pressure back on stocks.
And then the second report, maybe the highest impact one today, is the ISM Services PMI at 10:00 a.m. Eastern. The big focus here is squarely on the stagflation trap. The headline forecast is 50.8. That's weak, sure, but maybe not disastrous on its own.
But the devil's in the details, right? Specifically that prices paid component.
Exactly. The absolute worst outcome, the thing that really kills the soft landing story, is if we get that weak headline number showing slowing growth at the same time as we get a high or even rising prices paid number, because that combination validates the slowdown and the Fed's inflation fears. It basically locks us into that stagflation narrative. Very tricky spot.
Okay, so this is where it gets really interesting then. The sources seem to suggest that today's regular trading, it might just be positioning. Positioning ahead of the after-hours earnings reports. That is the market's real verdict, isn't it? On whether this Palantir-led unwind is just a blip or the start of something, well, bigger, the after-hours gauntlet.
It absolutely is a gauntlet, because the market seems poised to take the results from 4 key tech companies reporting after the close as a kind of single collective judgment on the future of the tech sector, especially that AI infrastructure piece.
So who's in the gauntlet? We've got Robinhood testing retail investor engagement and those high-growth tech hopes, AppLovin testing ad tech strength, maybe the digital economy's health overall. And Qualcomm, that tests semiconductor demand, gives guidance on whether the smartphone market is recovering.
Right. But if you only have time to watch one report tonight, it probably has to be ARM Holdings. ARM is just so crucial. Its outlook is effectively a proxy for the entire chip industry's health because they provide that core IP, the fundamental architecture for almost all major chips, including the AI ones. So they're guidance. That's basically the market's blueprint for future AI investment. It's huge.
So what does this all boil down to for you, the listener, the investor? These reports tonight, they will either validate the idea that there's still strength left in the AI rally, prove that the Palantir reaction was maybe contained, maybe spark a bit of a risk-on reversal.
Or they will definitively confirm those Palantir-led fears. And if we get that confirmation tonight, well, we could see the start, maybe the swift start, of that 10–20% pullback that some Wall Street CEOs have been warning about. It really feels like validation or maybe confirmation of deeper worries for the AI valuation story tonight.
We've covered a lot. The convergence of that valuation stress, these new, potentially foundational legal risks for AI, and this unique pressure cooker of a critical economic calendar being watched in a complete data vacuum.
The stakes today are just incredibly high. The question isn't really if growth is slowing the bond market. The private data seems to suggest it is. The real question is whether inflation will drop fast enough to keep us out of a full stagflationary mess, especially when the official government data we usually rely on just isn't there.
This has been a deep dive into the sources for November 5, 2025. Now, here's a final provocative thought for you to mull over today. Given that the market, and maybe even the supposedly data-dependent Federal Reserve, are forced to rely almost entirely on private surveys like ADP and ISM, and on generalized sentiment from CEO warnings to figure out the economic outlook. Because the official government data like non-farm payrolls is missing due to the shutdown. What fundamental assumptions must you as an investor now challenge about the reliability, maybe even the neutrality, of the information you use to make critical decisions? Lots to think about there.